Hey, it's Over Criminal Space and Equity. We're all about increasing assets and creating new space. Here today to discuss $5.8 billion is due to mature. They won't find a home, meaning at maturity, the loans will not underwrite to approval. Not sufficient enough rents. The current interest rate is too expensive for how much money is being collected. In 2024, some loans were kicked out. They received loan extensions, meaning the existing terms that were in play when the loan started, perhaps in 2019, got extended for a year. They were supposed to mature in 2024, but they gave them an extension, maybe giving the client time to perhaps liquidate the property, to do something differently, or hopes that they could collect, bring more tenants into the place, and finally that rates would drop further than they dropped. They didn't drop that much. They have dropped some since 2024, 0.5%, but not enough to make a significant debt when they needed to drop maybe 2 or 3% for the new rent roll, the revenue coming into the property to be able to absorb the expenses associated with it. Because your revenue after overhead, the net rents need to be able to cover the mortgage payment, and that's not happening. So that $5.8 billion won't find a home. But there's way more to mature. There's actually in 2025 scheduled to mature about $957 billion worth of all classes of commercial real estate. That is multifamily apartment complexes, that is medical office, that is retail, that is office that we're talking about, all sorts, all those, and that's industrial. All those classes of real estate, about it, just shy of $1 trillion will mature in 2025, meaning then the loan will expire or be done, but there's still a balance left, and that balance either needs to be paid off or refinanced. Of all that, basically $1 trillion, let's say 200 billion of that is office that's maturing in this year. Right now, office has a default rate, or they're not the loans are not being paid according to the standards of the loan agreement. They're not being paid on time. They're not meeting certain covenants like debt service coverage, uh, loan to value. They're out of compliance, so they're in default. 8.1% of those are in default. So if the number was 200, 10% of 200 is 20 billion. So around 16, at 8%, you're talking about $16 billion that are out of payment compliance, out of covenant compliance, at risk of being charged off. When that happens, bank has to allocate more money towards, because in general, if all your loans are what they're supposed to be, there's no, you generally have to put aside at least 10% of reserves. When the loan gets more complicated, like you have a higher loan to value or you're doing stuff that is a little bit more risky, then you have to have more reserves. Well, when the loan is in decline, maybe non-performing, you got to have more reserves on that. So you got to set aside more of your capital, more of the bank's cash to protect against this loan being a loss. And then in the event when you actually charge off the loan, then you have more expenses. You got attorney expenses. You got accounting that is going to come into play. You may have to manage the property itself. You got to pay taxes on the property because now you're the direct owner of the property, not just the mortgagee, the mortgager of the property. You're the direct owner. So your expenses increase. What's happened to the community banks of the world, the banks in that 100 billion down, they were the players of commercial real estate transactions, the day-to-day commercial, not the huge stuff that you see in New York, but the day-to-day, the 20 million, the 5 million, the 10 million. They were the go-to, and they were really good in real estate. What they aren't very good is what we call CNI transactions, because these are balance sheet transactions. These are the hard assets of the world when you're doing in commercial, and let's say a trucking company would be considered a CNI business, right? Their contracts, their receivables, that's kind of intangible. Those are the people that are supposed to pay them. Hey, I've got a contract with FedEx. I've got a contract with Amazon. I got a contract with Walmart to distribute. So I have contracts with these large corporations, but that's my accounts receivable. That's collateral. And then let's say I've got a company and that my inventory, the stuff I stock in my stores, That's a piece of collateral. Those are the challenge with a smaller regional bank that's used to doing real estate transactions. It's a little bit more nuanced on the commercial industry. Your collateral is less tangible. So what happens is you can typically companies, all banks know how to underwrite to a balance sheet. They know how to assess the risk associated with the strength of the balance sheet. Hey, do you have assets on the balance sheet, or do you have no assets? Is your debt to worth 3 to 1, or is your debt to worth 1 to 1, or 0.2 to 1? All banks know how to underwrite that, but it's the larger banks that have systems to underwrite to assets at what we call asset-based lending, where the asset is something intent like a widget. Because guess what? If that widget is not meeting its metrics, then you know there's something problematic. The borrowing base, the group of assets for the line of credit, you can, if you have systems in place, you can catch it early. Like, hey, this is not performing. I got to shut this down. I can also underwrite to the fact that I have an asset that's going to move. I know the cycle, and I can underwrite a lot to that cycle and put a little less emphasis on the bank's balance sheet itself. Community banks aren't designed for that. So now, but community banks are having to go chase that business because they're too saturated. They need some offset against the real estate. And the only way they're going to get the deposits they need is providing lending in spaces they normally don't provide lending in. So that's how it impacts you in the community, is that the bank's balance sheet is squeezed. They're going to have to put more money towards loan loss reserves. They're going to have to put money towards loan defaults that completely default and charge off. And then to offset, to get the deposits they need, they're all in the same boat saying, we need deposits, we need cheap deposits, we need checking accounts. To get those checking accounts, they need to go to commercial and industry companies that have strong balance sheets, that have cash. And if they do that, to attract them over, I got to give them loans. I got to give them loans in places that I don't understand as much as I understand the real estate business. I got to go play in this business. So what do? Oh, I got to have an owner occupied special because I may not know how to underwrite to that CNI, that commercial industry company, but I can underwrite to the real estate that's owner occupied. I'm gonna package that. So everybody's fighting for the same pot of business. Everybody's now, we got $1 trillion of real estate coming to renew. Some of that is owner occupied. We got to all jump on that. And hopefully the company's doing strong enough where they can afford the rent, their mortgage, the interest rate may have been 4.5, may have been 4%, maybe been 3.99. Now when it's come to maturity, there might be at the lowest, 6.8, 6.9, more like 7 to 7.5. Can the company handle that? So just as the economy is being squeezed, banks are squeezed as well. And it's not about saying, oh, woe is be the bank, but you got to know that when you're dealing with a bank, it's a partnership. They've got needs, you've got needs. And the hope is to marry those needs together. Like, hey, you can win, I can win. When it's only one side wins, there's no ball to be played. And right now, banks are only playing ball with people that can bring them deposits. Space and equity, we believe in increasing assets and creating new space. Reducing your risk by increasing independence. Everybody's not an entrepreneur, but you can increase your independence by having the right financial pathway, by being equipped with information. When you come correct, they can't stop you.